Private credit did not emerge to replace banks. It expanded when banks stepped back. Over the past decade, trillions of dollars have moved into private lending funds that operate outside traditional deposit-backed banking. These institutions finance corporations, real estate projects, and leverage buyouts without the same capital rules or liquidity requirements imposed on banks. During periods of stability, this shift appeared efficient. Borrowers gained access to flexible financing. Investors captured higher yields. Risk seemed distributed rather than concentrated. But private credit relies on assumptions that have not been tested in a full credit cycle under higher rates and tighter liquidity. This is the story of how a rapidly growing parallel lending system became central to modern finance and what happens when flexibility meets stress. Private credit refers to non-bank lenders that provide direct loans to companies without using public markets or traditional bank balance sheets. These lenders include private equity firms, asset managers, and specialized credit funds. They raise capital from institutional investors such as pension funds and insurance companies. The growth of private credit accelerated after the global financial crisis. Stricter banking regulations reduced banks' appetite for leverage and mid-market lending. Borrowers seeking capital turned to alternative lenders. Over time, private credit evolved from a niche strategy into a major segment of global finance. Funds structured long-term, floating-rate loans to corporate borrowers, often with fewer disclosure requirements than public debt markets. Unlike banks, private credit funds do not rely on insured deposits. Their funding comes from committed investor capital. This structure reduces traditional run risk, but introduces other vulnerabilities related to liquidity, valuation, and interconnected exposures. Private credit sold control and resilience. Fund managers argued that direct lending allowed for better underwriting standards and closer borrower relationships than syndicated bank loans. Investors were told that private structures offered stable income with lower volatility than public markets. Because loans were not traded daily, price fluctuations appeared muted. Valuations were updated periodically rather than continuously. This reduced visible volatility, reinforcing the perception of stability. Borrowers benefited from speed and customization. Deals could be structured quickly, with fewer intermediaries. Private lenders often accepted higher leverage in exchange for higher returns. The broader promise was insulation. Without daily mark-to-market pressures or retail deposit exposure, private credit was portrayed as structurally more stable than banks. This perception encouraged growth. Assets under management expanded rapidly. Private credit became an essential funding channel for middle-market companies and leveraged transactions. The promise was not risk-free returns, but predictable income in a diversified portfolio. What remained uncertain was how these structures would behave under sustained economic pressure. The rise of private credit was fueled by low interest rates and investor demand for yield. Pension funds and insurance companies allocated increasing capital to private funds seeking returns above public bonds. As capital flowed in, fund managers expanded lending activity. Loans were extended to companies with higher leverage and more complex capital structures. Private credit increasingly financed leveraged buyouts, infrastructure projects, and commercial real estate. The scale grew quietly. Unlike public bond markets, private credit transactions were less visible. Reporting was limited and data collection lagged. Yet by the early 2000s, private credit had become a multi-trillion-dollar asset class globally. Banks did not disappear from the system. They often provided credit lines to private funds or participated in syndicated structures. This created indirect links between regulated and unregulated lending channels. The rise was not speculative in appearance. It was framed as institutional and disciplined. The combination of committed capital, floating rate loans, and negotiated covenants suggested adaptability. But growth occurred during an extended period of favorable conditions. Default rates were low, liquidity was abundant. Stress remained hypothetical. Private credit fails differently from banks, but it does not avoid systemic risk. Its vulnerability lies in liquidity mismatch and valuation opacity. While funds are typically structured with committed capital, the underlying loans are often extended to highly leveraged borrowers operating in cyclical industries. When economic conditions deteriorate, borrower cash flows weaken. Interest coverage declines. Refinancing becomes difficult. Because many private credit loans are floating rate, higher interest rates increase debt burdens for borrowers. What initially benefits lenders can eventually strain repayment capacity. Unlike public markets, private credit valuations are updated periodically. This reduces day-to-day volatility, but can delay recognition of deterioration. Loans may be marked at stable values while underlying conditions worsen. Losses emerge gradually, often through restructurings rather than immediate defaults. Liquidity pressure can arise indirectly. Institutional investors may reduce new commitments. Secondary markets for private loans are limited. If funds face redemption pressure or reduced capital inflows, they cannot easily sell assets without accepting significant discounts. Interconnection amplifies risk. Banks often provide leverage facilities to private funds. Insurance companies hold private credit exposure. Pension funds rely on its income. Stress in private credit can therefore transmit beyond the funds themselves. The system does not break through sudden runs, but through prolonged credit deterioration. As defaults increase and restructurings accumulate, capital buffers erode. If confidence declines, new lending slows sharply, constraining credit to the real economy. Private credit structure reduces visible panic, but it does not eliminate cyclicality. Its resilience depends on borrower performance and investor patience, both of which can weaken under sustained stress. A collapse in private credit would likely unfold gradually. Defaults would rise first among smaller, highly leveraged borrowers. Funds would extend maturities, renegotiate terms, and inject additional capital to avoid formal write-downs. As stress spreads, valuations would adjust more visibly. Secondary markets would reflect discounts. Investor confidence could weaken, reducing capital commitments to new funds. The contraction would not resemble a bank failure. There would be no insured deposit runs. Instead, lending activity would slow, refinancing options would narrow, and credit availability would tighten across sectors reliant on private financing. The broader impact would be felt through reduced investment and employment, not immediate financial panic. The system would not collapse overnight, but through diminished capacity to support economic expansion. The aftermath of stress in private credit would likely involve selective reform rather than systemic overhaul. Regulators may increase reporting requirements. Risk management standards may tighten. Investors may demand greater transparency. Yet demand for yield would persist. Capital would seek structured alternatives once stability returns. Private credit may shrink temporarily, then reconfigure under new terms. The sector's endurance reflects structural demand for non-bank lending. Its vulnerabilities reflect the limits of insulation from broader economic cycles. Private credit would not disappear. It would adjust, as shadow banking has before. Private credit illustrates how financial systems evolve beyond traditional banking. Regulation constrains one channel, and capital flows into another. The result is not elimination of risk, but redistribution. The strength of private credit lies in flexibility and long-term capital. Its weakness lies in opacity and concentration. When economic conditions shift, stability depends less on structure and more on borrower resilience. The lesson is not that private credit is inherently fragile. It is that scale changes significance. As alternative lending becomes central to economic financing, its performance during stress will matter far beyond the funds themselves.